Monday. This is Jay Brew, co-chairman of Seifried and Brew. One of the things in terms of the Seifried and Brew Total Risk Index, which is on the website, you can go and look at every bank in the country, is that we're working on a project because there was an article in S&L last week talking about continued bank failures, the fact that the FDIC had slowed down on purpose in order to draw more buyers in, the 800 banks that are on the watch list. When you think of that, and the way, of course, that the media picks up on it, is that there's a huge number of bank failures yet to happen. Yet we want to somewhat quantify that, because when we looked at the banks that have failed recently, of course, they were up in the very high reaches of the S&B Total Risk Index. The thing is that if you look at the bank that I've helped to found, Embassy Bank in Pennsylvania, is that you'll see that that is listed as a relatively high-risk bank. The thing is, though, is that what you have to do is dig deeper in terms of risk. And where the Seifried and Brew Total Risk Index acts as an overall indicator of risk is, once again, it's an indicator. It's, if you want to call it, a series of red flags, looking at capital risk, credit risk, earnings at risk, and liquidity risk. And all of those go into so much more depth below that particular index. So that what we really want to do, and what I do with our board, is that we look at each one of those portions of the total index to determine where our risks actually lie. For instance, many banks that have had increasing net interest margins are actually going to show a higher level of earnings at risk, and then that contributes into a higher overall total risk index. Yet, when one looks at it, it is a risk, because what it would sit there and probably say to us is, gee whiz, if our net interest margin is increasing during a period of low rates, the offsetting side would be if interest rates start to go up, that essentially that margin would decline. So then one has to dig deeper. One has to go into their asset liability models to sit there and say, well, what is the actual risk? Let's quantify that. And that is a useful exercise that every bank should go through. Had another situation recently where a bank was showing overall moderate risk, yet their liquidity risk was high. And this upset the CEO that, gee whiz, we have a high liquidity risk. Yet, when you really looked at the mitigants of that risk, for instance, one of the things that we would look at discussing a high liquidity risk would be, for instance, their cost of funds. Are their cost of funds higher than, say, the national and state averages? Or are they lower? Is that due to a larger number of those cash-type deposits, which include checking, savings, and money market? Are they higher in terms of national average? Are they lower? And also looking at state averages. So that one comes up with mitigators that would suggest that that risk for that particular bank, I would judge, would actually be a moderate to low risk, because this bank had a high volume of cash-type deposits, close to 70%. Their cost of funds was significantly below the national averages. But one of the things that can offset these different factors would be things like loans to assets. This bank had a higher loans to assets figure. That contributed to them to having a higher net interest margin. So there's many pieces when we look at this, and it's really deeper than just simply one number sitting out there. The number indicates an overall level of risk indicator. One then has to go in and really dig deeper to sit there and say, is this risk for real? But what we know and what we've proved in the past over the failed banks and banks that have problems is that these risk indicators were very much real. They should have looked at them many years ago and adjusted their overall risk. And what has happened is that these banks have had problems, they've had issues, and many of them have failed. So when we look at it, we really have to look at the Seifried and Brew Total Risk Index as not just simply a grade. A lot of bankers look at it and say, well, this is my grade. I don't know if I agree with it or not. In this day and age, post-financial crisis, and what we've been through for the past couple of years, we really have to be more open-minded to sit there and look risk straight in the eye when there's an indicator. And then sit there and say, is this truly a risk? What are the things mitigating that? And have discussion and whether or not change needs to be made. This is Brew, co-chairman of Seifried and Brew.